Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Brian Joyce. He's a managing director on Nasdaq's Market Intelligence Desk, also our chief market technician. We have Brian here. He's going to let us know what technical analysts look at when they're determining if bonds are leading the way in terms of what we're seeing with the equity volatility. Brian, it's great to have you with us, and thanks for taking us through this because you have your fundamental ideas in terms of where this is going to go, up, down, bottom, top. But price action is really where you're getting that confirmation from in these volatile markets. So I want to go right into this. Let's take a look at our first chart here. This is the U.S. Treasury. It's a daily chart, and this really has been the story in the markets with yields just continuing to plunge.
Yeah, I mean, the move lower has really just been nasty, I think is the best way to describe it. We had, some consolidation along that 195 to 2% range. Largely for a large part of the fourth quarter, it was previously support, then acted as resistance. I was expecting an upside breakout through that level. It didn't play out that way. And what really led me to believe that I was wrong and that the move next was lower was in late January when we had that break below that 170. 170, 171 level, which was minor support, but it really told you that that recent 3-month uptrend had reversed, and now the next move was lower, and that was at least the way to play it, or at least expect a longer period of sideways consolidation. The next support level was 150. We broke that 2 weeks ago on Friday when the equity market kind of broke as well. We had news then about Japan and South Korea seeing expanding cases of coronavirus, but less spoke about also we had an economic data point, the ISM, the market ISM services number, which is really a barometer on a bigger part of the U.S. economy as opposed to the manufacturing figures, which last year did go into contractionary territory, but we finally saw it on the services side for the first time 2 weeks ago, and that was really coinciding with the other news about coronavirus that really combined, caused the yields to break support, the S&P broke support, and the U.S. dollar broke support all in the same day.
And you know what, Brian, to see a move like that, I believe in last week alone we saw a 30 basis point drop in yields. It's not typical for yields to have this kind of reaction in the market. They tend to be a little bit more steady than you would see in equity action, for example.
Correct, and they tend to be a safer play, more longer-term type of investors are in this market. On the long end of the curve, you don't see this volatility. It's not typical. I think the weekly move last week might have been one of the largest weekly moves we had on record, and not shown here in this chart, but we'll see it on the next chart. But that 135, 140 range, let's call it 132 to 138, was really a major support level where we had tested a number of times going back to 2012. And that was where, if you
let's take a look at that chart. Let's pull up.
Yeah, let's go right to it. If you were a bond bear or you want to see yields go higher and stabilize, and if you're a bull on equities and risk sentiment, that's what you want to see. That's where you wanted to see this level hold. And so you can see back here in 2012 when we had the Euro crisis, we bottomed at 138. In 2016, when we had a significant low in the equity market, we bottomed at 132, essentially the same level. And in Q4 18, we bottomed right around there as well. It might have been at the midpoint, or let's say 141, but essentially all right at that same range. That's major multi-year technical support. That level you want to see hold. When that breaks, that's market is telling you something has changed and you need to pay attention. We were just coming off a stock market, the S&P 500, with 19.1 times forward PE valuations, extremely high equity valuations. And what does the bond market do? The bond market is telling you there's something very wrong going on. And so when that level broke, we saw the waterfall down. Since the bonds have never been at this level before, there's no obvious technical support. Now the range of the last couple of years is 170 basis points. We bottomed, let's say 135, and we peaked up at roughly 305. So what technicians do to try to project where this yield is going is they take that range and then they subtract it from the support, which in this case would take it to roughly minus 30 basis points. So that's not my prediction, it's not my forecast, but a traditional technical analyst would look at this type of chart no matter what it is, a bond yield, a stock, a commodity, and they would have a price projection of roughly minus 30 basis points, which hopefully we do not see that, because if negative yields take place here in the United States, that certainly didn't bode well for the banking systems in Japan and the banking systems in Europe over the last 10 years.
It's really quite extraordinary. February 19th was the high just about 12 trading sessions ago, and the move has really been quite extraordinary. Let's move on to our next chart here, talking about the yield curve. And we heard a bit about this in 2019 with the way the yield curve was positioned, inverted, not inverted, and potentially we can go into recession. Those fears were wiped away. It's front and center again.
Right, and so the curve did invert in last year in the summer of 2019, we had the trade war, we had trade tariffs. Not long ago before that, we had the Fed just finishing up its cycle of rate hikes and quantitative tightening. That caused a lot of volatility in 2018. When the Fed cut rates in 2019, it did help out the curve. The curve went from negative back to positive, and this on the blue line is what we see how the curve was positioned or how it was sloped at the end of 2019. And now you can see it's very different. The Fed just cut 50 basis points, and still every maturity, with the exception of the 30-year maturity, is below the lower bound of what they just cut it to. Futures are now expecting another 50 basis point cut at the meeting on March 18th, at least 50 basis points. And so it's getting now possibly towards a third. I think it's about 20% expectations for a 75 basis point cut.
All right, now the million-dollar question is, are bonds signaling more downside for the equity market? And we're going to take a look at this in our next chart here on a 30-minute of the S&P 500.
Right, so we can see here, this is a zoomed-in view of what's been going on. The recent 52-week high is right up there, made back on around the 19th or the 20th at that 33.89 level. We had a 16% move to the downside. That equates to 538 points. I'll tell you why I mentioned that. The ensuing rebound was roughly 10%, which exactly hit the 50% Fibonacci retracement. That's an expected resistance level. If it really convincingly broke through there, just above it is the 61.8% retracement. That's common levels where you would expect for stocks, let's say, or an index in a downtrend, when they shoot back higher, that retracement, that's where you would expect overhead supply to kick in. So far, we've seen that. It doesn't necessarily mean that the recent pullback today and the recent pullback midday yesterday or the day prior is going to hold and we're going to go lower from here. I still want to wait and see how this near-term price action is going to play out. I would say right now we went from a relief rally to sideways consolidation. That's how I would characterize it, with the potential that we continue to go further higher up. If we do, I think around the 3250, 3280 level with our price gap from last Monday, that to me would be my highest expectation for this relief rally,
right,
in the near term.
I mean, this is awesome if you're a trader. We haven't had this kind of activity in a couple of years at this point.
Yeah, this is certainly a trader's paradise.
It definitely is. All right, let's take a look at our last chart here. This is S&P 500 on a weekly chart, so you can get a little more of a longer term view here.
Right, and so if the recent highs that we just highlighted from yesterday do hold, and we mentioned that the move down was 538 points, a lot of technicians expect to see the overall correction to be a three-wave correction. Wave A down, wave B up, and wave C down. And if it's a textbook type of correction where wave A is parity to wave C, meaning another 538 basis points, that would project to roughly 2,600, which would come within 1.5% of the 200-week moving average. Why is that level important? Why is that moving average important? Well, because the four biggest corrections that we've seen, three of the four biggest corrections we've seen since the crisis in 2008, happened in 2018, 2016, and 2011. And all three of them bottomed almost exactly to the 200-week moving average. In 2018, that dropped to the penny to the 200-week
so
moving average.
So then we have a little bit of room to go if that theory holds.
Right, so that would equate to maybe another, 15% downside from here. But an overall correction, high to low, of roughly 21, 22%. The one time that it didn't was in 2010, but the 200-week hadn't yet come into play yet. It actually marked the top before we then rolled over in the equity market for a 17% correction. So it's not my forecast again, but if we do make lower lows, I think at the minimum we're going to see a retest at some point of last week's lows. If it gets worse from there, and the bond market is signaling that I think it is, if it does get worse from there, I think the potential is for a test of the 200-week moving average.
Good way to establish risk levels, for sure. All right, Brian, thanks so much for joining us as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.